Welcome to Shark Cap Table Fast, the 1-minute deal maker for sellers and buyers of equity that helps you keep your arms and legs. First, we must set up the tool. Go up here to the upper right-hand corner. It must read Sell Shares. It must read either Shark, Investor, or VC. Let's set it at Shark. It's more fun. And I just want to let you know that there's a lot of helpful detail, such as all of this, and this, and this, and this, and this, but let's hide it to keep the clutter to a minimum. Now we're ready to go. Let's put in some founder investment, let's say $15,000. And the detailed founder valuation, I'm going to move this down here temporarily so you can see it. This is the pop-up help, which is prevalent throughout this model. Detailed valuation, any beta test revenues, intellectual property or patents, quality of management team, market size and ability to capture share, other intangible or tangible assets, or use what is generated from sheet detailed founder valuation. Let's move this over, keep the screen clear, and let's dial in, say, 500,000. And I'm going to go over here to the red tab, which is immediately to the right of Shark Cap Table Fast, the green tab, and we're just going to take a quick look. We've got some components here. You don't have to use these if you don't want to. We're going to spin in that number right there, which is estimated from Fast. The rest of these numbers, when we get to Light, which is a more detailed version, we'll then have a choice as to what we want to use. When you argue the point, it's good to have the details. When you're just trying to get an idea of what you have, it's great to just have a quick estimate. So let's go back to Fast and use that quick estimate of $500,000. No detail. Now, we've arbitrarily set the price per share at 1 cent. So if we put $15,000 in, we have 1.5 million shares. The option pool is going to be set at about 15%. You can see that concatenated in this line item. Professional investors like to have a option pool. It protects their interest because they could always bring in a bigger, heavier honcho to run the company, and they themselves do not get diluted. You do as a founder. Okay, so now let's move on. Let's go to what we think we can sell the company for, which, hey, let's say $2 million in year 4. And we're looking for $300,000 from the Sharks. And there we are, $300,000. Now, the important one is the Shark pre-money value. It is the Sharks or investors' opinion of what you're really worth. You think you're worth $515,000, which is $500,000 of tangibles and intangibles and $15,000 of cash spent to get where you are. So let's go in here and make this about $400,000 if we can. This is going to be moved and changed by the investors as you negotiate, but this is not a bad starting point to see what might actually transpire. So let's go look up here at the fully diluted ownership stakes. Options are going to get 7.5% upon exercising their options. Founders then will have 49.7%. Sharks will have 42.9. The investment multiple for the founders is 66 versus 2.9 for the Shark. That's predicated, of course, on a year 4 sale at $2 million. Moving over to the internal rate of return, the founders have 185%, while the Sharks have 30%. And when you see green, that means that the founder and the Sharks are in good shape with control. Green means founder has control. Now, we've got a potential deal here, which is good. I need to get rid of this dumb thing. There we go. Okay, so one more thing about this is that we've got a summary that takes all the key numbers and puts them into a real sentence, grammatically correct. You can cut and paste and put it into your pitch deck or even a business plan if you like. So there we have the foundation of a reasonable deal. Now, we could do one other thing. We could come in here and say, gee, let's get this down to 40% so we could reduce the amount of money that we want to maybe that amount there to get us to that 40%. This is no magic. It's just that if you give away close to 50%, the next time you raise money, you're then going to be out of control. And the idea is to try to maintain control as long as possible. You could perhaps make the case for going to 3 million or 4 million in year 5. That raises the shark internal rate of return as well as their multiple. So maybe you could make the case that you go up a little bit on your, well, we went a little too far. Maybe we can get to that point there. That's a little bit better. The other thing you could do is you come in here and you actually raise more money from the founders. Let's go to like $50,000. And maybe you have to get some from friends and family before you hit up on these VCs or angels or whomever. So there it is, 65.35, high price to sell in year 5. Get a little less money, but that's a possible doable deal. Okay, so thanks very much.